Hi and welcome to FinCrime Agent. Today I have the pleasure to talk about tax risks with Marisol Martinez. She's a good friend of mine and a professional who's been working in the financial crime space across risk and compliance role for leading financial institutions. So without further ado, let's jump into this week's Q&A with Marisol Martinez. Hi Sol and welcome to FinCrime Agent. How are you today?
I'm doing really well, Marco. Thank you very much for having me. And first of all, let me congratulate you on your channel and keep up the very good work that you are doing.
Thanks for the feedback, and it's a great pleasure to have you on FinCrime Agent. Before we get started today to talk about tax risk, I would like to clarify to our audience that what we are discussing today is based on our own views and therefore those don't represent the position of the companies that we are working for. So with the housekeeping out of the way, could you please share with our audience your background and perhaps let us know what you're up to in these days?
I'm the Global Assurance Tax Risk Expert at HSBC and I'm currently based in London. After almost 10 years of private practice as a tax lawyer, I joined the financial services sector 12 years ago. This professional journey included becoming an expert in risk and compliance, and I am a certified internal auditor. And regarding the second part of your question, Marco, what is keeping me busy? Now I'm currently focused purely on tax and from a compliance assurance perspective. I'm focused on raising the tax risk awareness of our teams, and I want our compliance officers to truly understand the risk. I'm committed to break information silos, learn lessons, and share best practices globally. As you well know, Marco, we demand a lot from our teams. We want experts in different risks. They have to be good at performing assurance and audit work. And at the same time, we want them to embrace technology and keep up with regulatory changes. I always say that there is never a dull day in risk and compliance, and these days are certainly exciting times. And I think channels like yours keep us up to date with anything that we need in this exciting learning agenda.
Thank you for sharing this with me and with the audience. So let's maybe get started with some of the questions. I know that the Financial Crime Finances Act in 2017 has introduced a new corporate offense for the failure to prevent the facilitation of tax evasion. So I think it would be interesting perhaps to clarify what are the key tax risk typologies that are now in scope for compliance functions. So maybe can you please talk about that?
Sure thing. With the introduction of the new legislation in the UK in 2017, we have to up our game in terms of tax evasion and particularly customer tax transparency, Marco. The corporate criminal offense, called very famously known as CCO, makes financial services like banks criminally liable unless they can demonstrate reasonable procedures are in place. As your audience knows, tax evasion is a predicate of money laundering. And tax evasion means basically the dishonest concealment of assets, gains, or income to reduce tax liability. Customer tax evasion risk is the use of financial services and products to commit or facilitate tax evasion. So to the question, when does tax facilitation risk materialize? It will take place when a financial entity, its staff, agents, or associated persons dishonestly facilitate another person to commit a tax evasion. And the part of the associated person is such an important part nowadays because you know how important third-party risk management is becoming in all type of entities, but particularly among financial institutions. So in light of this increased scrutiny, compliance areas are redefining priorities and raising the profile of its staff and systems and in this case with relation to tax. The UK regulator sent a very clear message to all. We cannot assume that general and shared AML controls will do the job. Global standards have been lifted, the expectations are much higher nowadays, and we will start to feel this more and more each day.
That's very clear. Thank you, Sol. And with that clarity now in place, I assume that tax authorities are now embracing a number of technology solutions in order to monitor those tax risks. And can you tell us of any changes in terms of the technology or on the evolution that you probably have seen in this sector?
Indeed, Marco, tax authorities have been embracing technology for decades now. The challenges faced today to manage tax risks are shaped by the pace of regulatory changes and the digitalization of tax authorities. Our generation and future generations will demand tax transparency, and the explosion of data and technological advances are assisting in that fight against financial crime. Remember that, of course, the bad guys also have the ability and the money to use technology as well. So we need, and we are very conscious of that reality. May I give you two examples, Singapore and the UK, which are among the leading tax authorities transforming themselves. Singapore, for example, is believed to have the least complicated system for paying taxes in the world. Why? Because they are using data science and behavioral insights to design simple processes, make paying taxes easier, and also detect tax evasions and fraud. For example, at the beginning of the year 2000s, Singapore authorities replaced many of their traditional operational staff with data scientists. Another example closer to home is the UK. In the last decade, the government have provided HMRC, the regulator, with 1.3 billion to transform itself into one of the most digitally advanced administrations in the world. The daily goal is to reduce the need for annual tax returns, and they want to create a single view of a taxpaying affair, and that will be a game changer for tax authorities. They are planning to define how much you, Marco, as a taxpayer need to pay based on all the data they have. They have information not only about you, they have information about your activities, your transactions, and they will be able to compare whatever you are doing in your industry and the field with your peers. And that information is crucial. In the UK, they are a bit delayed with this transformation due to Brexit preparations and of course now with COVID, but definitely the UK tax authority has transformed itself in the last decade. Another example is the US. If 2 weeks ago when President Biden gave his 100 days agenda, you notice how they are saying that tax authorities will increase the audit powers. Not only the powers, but they will have, thanks to technology, the ability to expand and have much more taxpayers under audit, because they have the tools to be able to manage more than one audit at the same time. So it's amazing what technology is giving, and we will all start feeling the outcomes our tax authorities planned many decades ago.
There is an aspect in here of CDD that will need to take place, as well as possibly transaction monitoring with that profiling that you were mentioning, with the use of technology to understand when someone's profile may or may not be in line with the expectation from a tax purpose. So those are probably CDD and transaction monitoring, some key areas that are directly impacted. Would you be able to maybe share any detection scenarios or maybe typology of scenarios that regulated institutions should be aware of to optimize the identification of tax-related risks?
Yes, specific tax transparency transactional risk indicators are slowly being incorporated into transactional monitoring systems in order to assist in identifying suspicious tax evasion scenarios. Currently, key financial institutions, what they are doing is that they are trying to combine existing general transaction monitoring scenarios with aspects of, for example, high tax transparency countries. And these will help develop a list of potential high tax transparency risk transactional indicators. You know how important for tax purposes are nexus or domicile. So one scenario could be that we need flags to identify, for example, when a non-resident individual with no clear nexus in the booking center, they are having a significant value of deposits of foreign source income. Or if you see significant amount of continuous offshore ATM cash withdrawals by non-residents or customers with no clear nexus. So in that way, you combine what exists in our TM systems and with lenses from a tax transparency point of view.
Yeah, understood. And I can see that there are a number of changes in here in the tax risk space taking place now from a regulatory perspective and a technology perspective as well. So how all those changes affected the approach that is taken by financial institutions to tackle tax risk from a compliance or even from a business perspective?
The demands for transparency while keeping an effective cost control should inspire risk managers and compliance officers to adopt a holistic approach to tax risk assurance. This approach is one that embraces technology, data, and behavioral sciences. And one, from a professional point of view, this approach has to be cross-risk. We can no longer run our risk in parallel. We know by now, we have the experience that they tend to create internal information silos that we'll have to break later. So we need to have that approach by design at the beginning when we define our risk control framework. This silo approach is detrimental and it is in opposition to the collaborative culture any organization needs to adopt nowadays. There's no doubt that we need to work collaboratively if we want to be cost effective and at the same time manage risk properly. For instance, product development requires a joint approach. Typical regulatory compliance controls need to include tax risk assessment as part of new products due diligence. And a very interesting point with regard to a different approach to training has to do with, for example, the apparently competing agenda in the hands of our relationship managers. In one hand, they have the obligation to be transparent about the products and services they are offering, but at the same time, they need to be mindful not to provide tax advice, as this is a highly regulated area. So we will see, and the first impact is asking our training agenda to totally transform in order to manage our risk in a more holistic manner.
Yeah, understood. So there is essentially a balance that needs to be in place, but overall the key point is the holistic approach is going to be key in order to make sure there is a business that is functioning properly, and on the other side a compliance that is taken into consideration. And based on your experience, what do you think are the main priorities at present in the agenda of tax authorities?
Marco, without a doubt, the tax authorities' commitment to end ban secrecy and tax avoidance schemes is a priority. With the current fiscal deficits in order to pay for COVID costs, gradual changes are now being accelerated. We see that in other areas, and of course, compliance and risk management is aligned to that movement. In the tax world, you know that there are thin lines between tax planning and tax avoidance, but nowadays they are almost non-existent. It is believed that nowadays, besides from profiting from explicit tax deductions or tax allowances, or the use of very simple family trust, everything else might include some degree of risk of being labeled as part of a tax avoidance scheme. And this situation is also putting training needs as a top priority. Client-facing staff needs to be aware of the ever-changing and complex red flags from a tax point of view, and they need to be able to identify complex multi-layer transactions that might imply or be labeled as a tax avoidance scheme. Our transaction monitoring system shall be constantly updating their scenarios, and the pace of regulatory change and the explosion of data will continue driving the agenda of taxation and other risk moving forward.
With the UK now officially out of the European Union, how Brexit impacted the tax compliance and risk sector?
Following the end of the Brexit transition, the UK has ceased to apply European laws. One of the most relevant pieces of legislation coming from Europe with regards to tax transparency is Directive 6, very well known as DAC 6. This European directive rules defines mandatory disclosure of potentially aggressive tax planning. This DAC 6 is no longer applicable, or when applicable in the UK, it is within the trade agreement signed between the UK and the European Union. In order to replace this, the local UK legislation is adopting OECD guidelines called MDR, Mandatory Disclosing Rules, and this is offering a similar level of protection as DAC 6. So this is just an example of how Brexit preparations and this transition and this managing of the situation of the UK having left the European Union has been intense, and it will continue keeping UK tax authorities quite busy.
Thank you. And lastly, since we already touched base about Brexit, I'm now curious to know if also the most recent change within the data privacy sector has impacted somehow the tax compliance sector. I'm of course referring to GDPR. So did you see any impact since the implementation of the General Data Protection Regulations from the EU?
This is a very good question, Marco, and the short answer is yes, of course there is an impact. And this is quite a hot and important topic, not only from tax, but from public law and private law and data privacy laws. The increasingly transparent regulatory landscape favors not only the exchange of information, the automatic exchange of information. And this situation interacts but sometimes conflicts with GDPR and its data protection standards. We know, I'm sure you feel okay accepting cookies in order to keep your Facebook account live. However, it does not feel that comfortable when we talk about sharing our financial data. In the last decade, and after the financial crisis of 2008 and huge tax evasion scandals, governments have empowered tax authorities to improve tax compliance and fight tax evasion and terrorist financing. So that's why I believe private-public partnerships are vital moving forward. The debate will continue, and hopefully this healthy dialogue will inform us, risk managers and compliance officers, how to play fairly and safely this very sensitive and complex balancing act of, in one hand, promoting tax transparency, and at the same time, we need to protect data privacy rights of our customers.
I agree with you 100% that that type of discussion would need to continue and be enforced further to manage the exchange of information for tax risk purposes. And with that, we got to the end of our discussion today. It was very enjoyable talking to you, Sol, and I want to thank you for coming to speak at a FinCrime Agent. Great pleasure to have you on my channel, and I hope we can chat again in the near future with more insight and industry updates from your end.
Thank you. Please, if anyone wants to contact me, I'm more than happy to share my passion for tax evasion and how to stop financial crime.
Excellent. I will leave your LinkedIn profile in the description of this video then. And a quick reminder for those of you watching who haven't yet subscribed to FinCrime Agent, remember to do so and press the bell so you will be notified once new videos like this one will go live on my channel. And that's all for today. Thank you one more time, Sol, and thank you all for watching. Until next time, see you soon.